and welcome to this week's asset class overview. Once again, I'm joined by Louise, and she's going to be giving us a bit more insight into some of the equity concepts that we discussed last week. So Louise, last week we spoke about what would happen if a company went bankrupt. And you mentioned that debt holders would be paid out before common shareholders would. Could you give us a bit more insight into why the debt holders have the priority in terms of those claims?
Yes, Sarah. So, when you are a debt holder, you essentially lend money to a company. And that company has a legal obligation to repay you, in the form of interest and the initial amount over the specified time period. Whereas if you're an equity holder, you are purchasing an ownership in a business. So the money that you are giving to the company is to buy a fraction of the companies. So you're not lending money to the company that needs to be, paid back to you. So with equity, there's no legal claim on the money that you invested in the company. But, you do, however, have more power and, unlimited upside potential for having ownership. And, for example, you have voting rights, you're receiving dividends and, also that potential for capital gains that we did speak about last week. And then also equities, should offer better protection against inflation when it's, compared to bonds. And the reason, for that is because companies' earnings, tend to increase with inflation. Whereas with debt, the interest on that initial investment amount that the company pay you is fixed in nominal terms, so it's not adjusted for inflation. So debt has a higher seniority ranking than equities, just because the company has that legal obligation to repay the debt holders, and it also serves as some incentive for investors to actually lend that money to the companies. Because, like we mentioned, they are restricted in that potential earnings that they can get.
Thanks for that insight, Louise. And then we also spoke about how share prices change over time. Is the only factor that affects share price supply and demand, or are there other things that we need to look at as well?
Yeah, so, in the short term, it's all down to supply and demand. It's investor sentiments, the attitudes, and expectations that ultimately affects the share price. And this can be affected, by company or economic news and market speculation going around. So for example, the more people want a share because it looks good based on some of these factors, the higher the share price will be, and then also vice versa. And I think, also just important to mention, equities is a very liquid asset class, which just essentially means that usually you can buy and sell equities, quite fast.
Okay, so if supply and demand only influences share price in the short term, what are the factors that then influence share price over the long term?
Yeah, Sarah, so in the long term or over long periods of time, the pricing is actually anchored based on the value of the share. So the price is driven, by company fundamentals, which are determined by analyzing different data and information, to determine the value, of the company. And that is essentially where you look at and analyze different factors, of the economy, of different industries, and also the company itself, to determine a value for that company. An example, of information that you would analyze, on a company level would be, financial statements. So I think just to summarize, in the long term, share trades around, for example, a certain price to earnings ratio that is anchored on the fundamentals of the business. But in the short term, it is due to sentiment and that supply and demand.
Well, thanks so much for clarifying that, Louise, and for all your other insights on equity. And thank you to all of you who joined us for this week's asset class overview.